Okay, and welcome back, students who are taking financial accounting, and we're working on the theory videos for chapter 1, business accounting and you, and we're on the 12th video. And as I was processing the last video, it occurred to me, why am I trying to break, I have 12 videos so far, I might end up with 25 videos. It has to do with processing of the size of the videos, and also too, we learn in small chunks. If I had, I could have made a video that's 3 hours long. Are you going to want to watch through 3 hours? Probably not. And yeah, you might, but you're only going to learn what's the beginning and what's at the end of the video by cutting the videos down into small, manageable chunks. If you watch one, like this last video was 9 minutes long, and now you take a break or whatever have you, you're more apt to retain that information. So that's why you're seeing so many videos, and why I keep on taking a little bit of, I stop and, in order to create a new video, right? It just seems like natural pauses to me, and however long they are is however long the video is. So we were here in the last video, and so now we're going to actually start to look at numbers. Okay. All right. So we had the explanation. If you ignore this part here and down and ignore all of this, remember this is what we saw in the last screen. All right, let me erase this so you can see it. Okay, that's what we have here at the bottom of the screen, right? Our extended accounting equation. And again, the book presents it one way, and I'm trying to present it in a different way. Hopefully it makes a little bit more sense to you. Okay. And we'll just, go from there. So remember, what you're looking at here and here is what you just saw right here. Okay. It's what you see right here. Now, before I go any further, I had said that, remember, assets, liabilities, equity, assets 1, liabilities is 2, equity is 3, revenues are 4, and expenses are 5. They're categories of accounts, right? But they're not the general ledger accounts themselves. Okay, we have to create general ledger accounts as an example. Assets would have cash, accounts receivable, okay, maybe equipment, automobiles, cars, land, buildings, whatever. They would be individual general ledger accounts that are all part of, the category of account called assets. Why? Because it's what the business owns. Our liability accounts would be like accounts payable, notes payable, loans payable, mortgages, payroll payable. Generally, they have the word payable after them because why? That's what the business owes, O-W-E-S. Okay. Our equity accounts would be our stock accounts, whether it's common stock or preferred stock. Okay. And we would have an account called retained earnings. And there's also our bonds and stuff like that, but that's getting way ahead of ourselves there. But just realize that under the equity accounts, you're going to have a common stock account and a retained earnings account. Now for revenues, they're going to be our sales accounts, okay? Usually there's just very few. I mean, you might have one, sale account, like let's say, for example, you're selling cars and trucks, right? Well, you can have just an automobile sales account and a truck sales account. Or you might break it down further by, let's just say you sell Ford, so you sell an F-150, an F-250, and an F-350 truck. Well, you might have an F-150 sales account, an F-250 sales account, an F-350 sales account. But they would be additional general ledger accounts. And of course, for revenues, you're going to have, a plethora of accounts, rent expense, advertising expense, utility expense, miscellaneous expense, whatever. Okay, so assets, liabilities, equity, revenues, and expenses are the categories, but underneath each category there are a whole bunch of other accounts that we're putting the information into. So when we're looking here and we're going to use an example, right? What the author in the textbook did was he said, okay, look at, we're going to have an investment in the business. All right, shareholders are going to buy $10,000 worth of common stock. Okay, and everything has to balance. Okay, we have a term called debits and credits. And when I ask the definition, if I ask students what the definition of debits are and credits are, students have a tendency to say, oh, well, they're plus and minus, credits being a minus and debits being a plus, or an increase and decrease. Okay, and that is the wrong definition for debits and credits. The definition of debits is what is on the left. What is on the left. And the definition of credits is what is on the right. Now, why is this so? Well, let's just take and look at this $10,000 investment in the business. Somebody comes along and they want to invest, so they buy $10,000 worth of stock, right? Well, in order to do that, they have to give the business $10,000 in cash. Well, cash is an asset, okay, and that's why it's listed under the assets there, and it's an increase, okay, because our cash went from 0 up to 10,000, right? But our debits, one of the fundamental principles of accounting is our debits always must equal our credits, always. Okay, and every day I have students say, well, my debits don't equal my credits. No, that means you did something technically wrong, because your debits always must equal your credits, and we'll get into that in the future. Okay, but for right now, realize that that's an inviolate principle. Okay, if your debits don't equal your credits, then that allows for cooking of the books and embezzlement. Okay, but by having debits always equal credits, we're able to find, if somebody's stealing from the company, by cooking the books, we're able to find that. Okay, so with our debits equaling our credits, when we invest in the business, we're giving the business the $10,000. Well, that increases our cash. Now, what am I getting in return? Well, I'm getting common stock. So as you can see, our common stock increased by 10,000. So our equity increased by 10,000. Now, here's the thing that I want you to be able to think about here. See this equal sign right here? This is in the middle of the accounting equation. Assets equals liabilities plus equity. Okay. So the question is what's on the left of the equal sign? Okay. What's on the left of the equal sign is an asset. And what's on the right of the equal sign? Liabilities and equity, right? Well, whenever we increase, and this is called the normal balance of that category of account. The normal balance of a category of account is what increases that category, meaning our assets were at 0, okay, and now they went up to 10,000. Well, what increases those assets? Well, for an asset account, it is a debit that increases the account. Okay, the normal balance of an asset is a debit, right? The easy way to remember this, as I said, is to look at the accounting equation here and see that assets equals liabilities plus equity. Well, what's on the left-hand side of the equal sign? Assets. What's the definition of a debit? What's on the left? So we know that whenever we're increasing our asset accounts, we're always going to be debiting it. Okay? That's going to increase our asset accounts. Now, the opposite of increasing is decreasing, right? So when we decrease, we have to credit the account. So for our assets, if we increase our assets, we're debiting it, and if we're decreasing it, we're crediting it. Now here's the rub, okay? And here's why you can't just say the definition of a debit is an increase or a plus, and the definition of a credit is a decrease or a minus. If we look at the accounting equation and what is on the right-hand side of the equal sign, well, liabilities and equity, right? And the normal balance is what increases that category of account. So if I have liabilities and equity and they have to increase, right? Because like in this case here, our equity was 0 and it just went up to 10,000, right? Well, what increased that category of account? Well, it's on the right-hand side of the equal sign, so that means we credit those accounts, all right? So we credit liabilities and we credit equity whenever we increase the balance in those accounts, okay? Whenever we increase. That's the normal balance of a liability and an equity account. But now, if we increase the liability and equity by crediting it, well then debiting, must be a decrease, right? Because if I credit on an increase, I debit on a decrease, just the opposite. Now here's the rub, okay? And this is why it can't be, debits cannot be just termed a plus or an increase, and credits can't be termed a minus or a decrease, for the simple reason, when I look at equity, my debits increase. I'm sorry, when I look at assets, my debits increase. But yet when I look at liabilities and equity, my debits decrease. Notice that I have a plus over here and I have a minus over here, right? The sign doesn't matter, okay? We increase on the debit side depending upon the category of account. If we're talking about assets, all right, then our debit, we would increase the asset on the debit side. But if we're talking about liabilities or equity, and we're talking about a debit, then we're talking about decreasing, okay? Now, what does that do for us? Okay, and this will be the last point I make in this video. What does that do for us? Well, as I said, debits must equal our credits. And for the vast majority of numbers on our books, we always try to deal with positive numbers, plus numbers, as much as we possibly can. So whenever I have a transaction, there always has to be two sides to every transaction, okay? And that's why it's called double entry bookkeeping. Oops, spelled it wrong. Bookkeeping. It's called double entry bookkeeping because we always have to have two sides to every transaction. So if I have a transaction and I'm making a journal entry for it, I have to have two sides. And those two sides have to be a debit side and a credit side. And the inviolate principle is our debits must equal our credits, right? And when I say must equal, like in this case here, we have a plus 10,000. Well, if that's my debit, then my credit has to be a plus 10,000. It can't be a minus 10,000. Plus 10,000 is not a minus 10,000. So when I take and I want to buy stock and I give the business $10,000 in cash to buy stock, okay, my cash increased from 0 and it went up to 10,000. And I know that that is a debit. Why? Because our assets increase on the debit side. So this has to be a debit of 10,000. Now, if I have a debit of 10,000 because I'm dealing with cash, and I know that my debits have to equal credits, that means I have to credit something else, okay? And now it's a matter of, well, what am I going to credit? Well, what is it I'm doing? Well, I'm investing $10,000 in the business. I'm buying common stock, okay? So that means if I have a debit of 10,000, that means I have to credit 10,000 somewhere else, and I'm going to credit common stock. Notice that my common stock went from 0 and it increased to 10,000. Okay? So when I'm looking at the equity account, right, what is the normal balance of an equity account? Remember, the normal balance is what increases that category of account. Well, the equity account is on the right-hand side of the equal sign, so we credit the equity account to show the increase. Okay, so our increase went from 0 to 10,000 in our common stock. So I have a debit to 10,000 for cash, and I have a credit for 10,000, and it's a plus. Both of these are plus, okay, to common stock. So my entry balances because I have a debit of 10,000 and a credit of 10,000. $10,000 came into the business in cash, and I have to have another side to the entry. And what was it being used for? Well, it was being used as an investment in the business to buy common stock. And so that's why I have a $10,000 entry on my books in this way. Now, this is the way the textbook presented the information. And I realize we're only talking about this half, right? We're only talking about this half. We're only talking about one entry here. And this is the way that the textbook actually presented the information. However, I had said there's more than one, it's all the same concept, but it all looks different, depending upon what's happening here, okay? So I jumped back up to this slide to say, okay, look at the overall scheme of things. I had a transaction where $10,000 was being invested in the business as common stock to purchase common stock, which also means $10,000 of cash was given to the business. Well, let me go the other way. $10,000 of cash. Oh, come on, Jim, do this right. $10,000 of cash was given to the business, okay? And that was a debit. And I had a credit to common stock of 10,000, okay? Let me format, okay, I'll just quickly talk about formatting. Okay, notice that this now is a journal entry, okay? I would have a date, whatever the date is, okay? And then I would have a debit to cash for 10,000 and a credit to common stock for 10,000. Notice that the credit here is indented a little bit, okay? And notice that we have two different columns here, okay? So our debits always are listed first, our credits are always listed second, and when we write the credit, we always indent it. Why? Because we're using two different columns, okay? The left-hand column, what's the definition of a debit? What's on the left is in the left-hand column. The credit, what is the definition of a credit? What's on the right? It's in the right-hand column, okay? And because it's in the right-hand column, that's why we're indenting the credit a little bit, right? So we have a date, and this is how we format a journal entry, and we put it into one of our journals, whether it's the general journal or one of our special journals. Now, once it's in the journal, it gets posted to the particular general ledger accounts. And that's what they're doing down here. They're actually not showing you the posting, the creation of the journal entry. They're just showing you what it looks like in the general ledger accounts. All right. So just be aware that the information, again, it can be presented differently, but it's all the same idea, the same concept, and it's just how it's presented. But if you understand the concepts, you have this sort of like X-ray vision to be able to understand what's going on as far as your books are concerned. Okay, so with that, I'm going to stop here because it's already 21 minutes. Okay, and I hope you understood that. If not, rewind it, watch it again. If you still have any other questions, feel free to telephone and speak with an instructor. But we'll move on to the next entry here, okay, in the next video. See you then.